Hello and welcome to the premiere episode of Dumb Money Diaries, and in fact, the premiere episode of the channel. Welcome to White Swan Finance, and here I am committed to steering you away from the common pitfalls that plague so many retail traders and showing you the true way to trade. So what is that way, I hear you ask? Is it a new indicator, a new candlestick pattern? Is it SMC? Well, no, it's certainly none of those things. And if you want to learn how every other loser trades, there is no shortage of channels for you. But here, I'm going to be showing and teaching you order flow, and specifically, we will be focusing on the footprint chart. Now, on first appearance, you are probably thinking one of the following. I'm not good at maths and there are too many numbers on the screen. It looks too complicated. I will never be able to understand it. I don't have a degree, and this will take forever to learn. I just like drawing boxes on my chart and labeling them three-letter acronyms like FVG. Well, I can tell you, you don't need a degree to understand these. You certainly don't need to do any difficult maths in your head. In fact, a big part of this is just pattern recognition and interpretation. And finally, they are not all that complicated. Yes, it will take you a bit of time to fully understand and be able to use them accurately, but a lot of you out there firstly need to realize that you need to take your trading more seriously. And secondly, you need to realize that the people telling you that they trade like the banks, they don't understand institutional order flow, and most of them have never worked in a bank or any kind of fund for that matter, nor have they seen what an actual trading floor looks like besides their Google image search. Do you really believe that professionals managing multi-million portfolios are drawing boxes on their chart, talking about order blocks and how to stop out retail traders during their morning briefing? Well, they definitely are not. Get a grip, forget the drivel you have been told, and learn how to trade properly. But if you aren't sure, follow along this series and you will soon realize why you are doomed to failure if you do not change your ways. So what is the Dumb Money Diaries? Well, in this series, I am planning on peeling back the layers of flawed beliefs and strategies that often lead retail traders astray. I plan on covering a lot, from Fibonacci to the so-called smart money techniques, and in each episode, I aim to help you break free from the trap of retail trading methods and show you a better and clearer path. So with that said, let's finally begin this episode. Today is more of an introduction to the world of order flow trading, but we're going to have a look at candlestick patterns. Specifically in the example coming up, there are two patterns that we're going to look at. One of them is the engulfing pattern, and the second one is a PinBar setup. And I want to briefly show you why blindly following patterns like this will always yield you inconsistent results. So let's have a look at my chart. You will see here that we are looking at the crude oil 5-minute chart from the 18th of June this year, 2024. And one more thing I want you to understand is here. Now, Singapore is 12 hours ahead of New York. So on my charts, where you see 3 p.m. for me is actually 8 a.m. in London. So that's the open of LSE, London Stock Exchange. And when you see 9 p.m. on my charts, that is 9 a.m. in New York, meaning the NYSE Open at 9:30 New York is 9:30 p.m. for me. So now that's understood, let's have a look at our example for today. Right, so as I said, we're going to be looking at two candlestick patterns in this example, both the engulfing and the PinBar. The first of which most of you will see on the right side of the chart. Now, the common thing retail traders will say is that the prices come up, left a long rejection wick at the high of day, and that because we were only able to break the high of day by 3 or 4 ticks, there must be sellers coming into the market And this is confirmed by the big red candle. And as you will see, if you took this as a short entry, you were very, very wrong indeed. So how could we have known that we should not be looking for a short trade here? Well, let's zoom in, and you will see all I'm doing is just zooming in, and we're going to take a look inside the candles, and I'm going to tell you some of the clues that I look for. So firstly, let's have a look at the bottom of the screen. You will see that the overall delta is increasing and that the min delta is almost zero, which tells us that at no point during this move have the sellers been in control. Now, another clue for us is if we look at the actual high of day itself, where what we can see is an unfinished auction. Now, I will zoom it in just to make it extra clear for you, but what this shows us is that there is still interest to buy this higher, meaning the last buyer has not bought. Now, maybe it will only go higher by a tick or two, but commonly an unfinished auction at the high or low of day is not a great sign for you if you are wanting a move in the opposite direction. If we also have a quick look at the so-called engulfing candle, what do we see? Well, nothing special actually. It's certainly not enough strong selling activity that it would make me rush to find a short, and nor would I be worried and close my position if I was already long. So there is no short trade, but maybe I'm looking to add to my long position. Let's see. Continuing to the right, we see that price comes down and any selling that existed is absorbed by buyers defending the area. You can see that we clean the low of this candle here, and we are now leaving a clean low. We have a finished auction at the low of this candle, and notice the volume profile of it also, and where the point of control is, which is the black box. These are all indications for us that buyers are still not done. Lastly, on this candle, you will see that right at the top, we have a large delta at price and a buy imbalance. Price continues up, and you will see that we retest this area where the buyers were previously strong, as indicated by the delta that I have colored in blue. Again, we only retest the area here where the buyers were strong, and then we once again continue the move upwards. If you like, you can pause the video so you can take a longer look and note the amount of buy imbalances in these candles. The buyers are very aggressive here. We now reach our next failed candlestick pattern, which is this bearish pin bar or topping tail, whatever you like to call it. But why would I, as an order flow trader, not only not care about this pattern, but even add to my position in anticipation of price continuing up? Well, firstly, do we have a finished auction at the high of day? No, we don't. So I at least expect a retest of that level, especially given how strong buyers have been in this move. Then think about what I was saying just now. On the way up, we were retesting areas where the buyers showed up. And again, remember, this is indicated by the blue lines on my chart, which show delta at price. So if we were looking long, where would we want to add and see defended by buyers? Well, it would be this area here where you see the largest, most recent deltas. Now you can see there was a large amount of volume that came through here. Many traders tried to take this short, but they were absorbed again by buyers and they are now trapped short. By the way, areas like this are a great place to trail your stop to once price has moved away and you can see that traders are trapped. So now we have come down a little. Buyers have shown up again and defended their positions. Sellers have been trapped. We've added to our long position. What do you think will happen? Well, we continue up and make a new high. We actually continue up for a while after this, but the main point I wanted to get across to you today was about not blindly entering a trade based on a candlestick pattern. So once again, we had an engulfing and a pin bar that by reading the actual order flow, we already knew would fail. And not only that, but we would have been able to find long entries in order to profit from the move as well. Right. So in summary, Stop blindly trusting candlestick patterns because they will not yield you consistent profits. Do start taking your trading seriously and learn how to read a footprint chart, because once you can, you will never look at a regular candlestick the same way again, and you will be accessing information that remains hidden to most traders. That's all for today. Please subscribe to the channel if you like what you've seen, and if you would like to learn more. The next video will be an introduction to footprint charts, and we'll have a lot more information and detail than today. Thanks again. I'll see you next time.
Grinding hard for that paper, cheddar stacking skyscrapers. Went from penny pincher, now they call me a wallpaper. Keep the hustle tight, nights on the block cold. Pocket full of greenbacks.